Today is Monday, August 4th. This is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. JP, we definitely saw some volatility Friday after the jobs report. What did Friday's report tell us?
Yeah, Friday's labor report was at best disappointing. The U.S. added a seasonally adjusted 73,000 jobs in July. That was below the 110,000 that many economists were expecting. But what was really the kicker was the sharp revision to jobs growth originally reported in May and June. Those revisions cut job growth down by a combined 258,000, leaving May as having just added 19,000 jobs and June an even smaller 14,000. The slower hiring is more in line with a cautious business sentiment that we are used to hearing about and a sentiment that we are seeing play out in economic data. Recent data and surveys of businesses have told us that many companies are leaving positions open and unfilled as they gauge the impact of the White House's trade policy on their business. Tariffs are weighing on manufacturing. Workplace raids are hurting immigrant-dependent sectors like landscaping and meatpacking. And additionally, cutbacks to the federal workforce are squeezing government hiring as well. The unemployment rate rose slightly to 4.2% from 4.1%. Meanwhile, the number of people unemployed for 27 weeks or longer increased to 1.83 million from 1.65 million in June. That increase in the ranks of long-term unemployment could be a reflection of an environment where layoffs have been low, but companies have been reluctant to hire, making it harder for people to find work without, making it harder for people to find work and employment. Meanwhile, healthcare and social assistance sectors continued on with hiring, but those sectors tend to do well no matter what the economic environment is. They're very anti-cyclical. In terms of report, it did tell us that what many economists were kind of already thinking, that the greater macro uncertainty will weigh on job growth as companies figure out just what's going on with their supply chains, demand outlooks, and how they can prepare their own economic forecasts accordingly. In terms of the Fed, this will likely trigger the Fed to cut rates in September. However, there will be plenty of time for the Fed to decide what to do. The Fed will also get another labor report in the meantime ahead of the September meeting, which could tell a bit of a different story as the tariff picture will most likely have played out by then. Other countries' tariff rates will be finalized, but still, the uncertainty regarding how those tariffs will impact businesses remains. And if we continue to see a labor market that is slowing, the Fed will certainly move to cut rates to support the labor market in spite of the higher inflation picture.
JP, Thursday there's a Bank of England policy meeting. What should traders be keeping an eye on as a result?
Yeah, so the Bank of England is expected to lower its key interest rate for the fifth time on Thursday. The bank continues a cautious monetary easing cycle in light of the high inflation picture in the country and also a cooling labor market there as well. The Bank of England's situation kind of draws some resemblance to what the Fed is facing here. Inflation has picked up, although that's largely because of government decisions regarding utilities pricing and taxes, which businesses have kind of pushed on to consumers as a result, increasing price pressures. Policymakers at the Bank of England do expect inflation to begin to tick back in the fall in line with the weak economic growth that should put downward pressures on prices, but policymakers overall remain worried that cutting borrowing costs too quickly could delay that kind of natural process. However, most officials at the Bank of England are worried that the high borrowing cost will result in lost jobs. This is creating somewhat of a balancing act there for the Bank of England that's resulted in the bank there gradually cutting interest rates by a 0.25 percentage point over 3 months. And that's a pattern that markets are expecting to see play out at this meeting, which would see another 25 basis point reduction. While the UK has negotiated somewhat of a relatively favorable trade deal with the US, there does remain a lack of clarity about the level of duties to be faced by other large economies such as China, India, and Brazil. The Bank of England has stressed that the impact of tariffs on global economic growth will be key to their ultimate decision regarding interest rates to the UK, not just specifically to them individually. The UK economy did start the year somewhat strongly, and that was mainly boosted by strong exports to the US as businesses there built stocks ahead of the anticipated tariff hikes, much in line with other European economies that also received a boost from front running in the first quarter, although that has significantly slowed in the 3 months to June, weighing on economic growth. We've seen negative GDP readings out of the UK over the last couple of months as well. Inflation continues to be sticky and picked up to 3.6% in June. So given these dynamics, I would actually pay attention to how the 9 policymakers vote in the meeting. There will most likely be 3 groups of votes, one group voting for a quarter-point cut, one group voting for a half-point cut, and one group voting for no cut at all. The 3-way split could reinforce expectations that the Bank of England will continue to stick to this kind of 3-month cut cycle, as it would be the best fit among decision makers that can't unanimously decide on what to do. However, any changes in how the votes are compromised should, one decision draw a strong majority, that I think should draw scrutiny from markets and could have signal what the bank will be doing moving forward and have some major implications there.
Thanks, JP. Mark, tariffs do continue to play a big role in some markets. How will tariffs affect soft commodity flows?
Well, let's start with cocoa. The tariffs announced by the U.S. last week left the minimal 15% rates for the 3 largest producers, Ivory Coast, Ghana, and Ecuador, as well as other important producers, Cameroon, Nigeria, Colombia, and Venezuela. So I would think this had a relatively small impact because it's the low end, but it does increase prices to U.S. consumers and put more upward pressure on candy prices. Still, the main factor for cocoa would probably be the main crop 2025 production, which starts in October. Coffee, a different story. There's a 50% tariff placed on Brazilian imports, and there's been no carve out for coffee. The U.S. gets about 1/3 of its coffee from Brazil. The U.S. is the world's largest consumer. So the U.S. would have to find new sources, and Brazil would have to find new buyers, and this will affect the movement of coffee around the world and thereby increase prices to U.S. and that could hurt demand. Now, China over the weekend announced it approved 183 new Brazilian coffee companies to export products to that country, and Chinese coffee consumption has been growing. So Brazil already working on new export outlook. Also, there's this possibility that maybe some importers exporters could sidestep the tariffs by first sending it to another country and then having it from Brazil to another country and then have that coffee move into the U.S. Some could bring the effective tariff down to 10 or 15% because there's not really a traceable supply chain. Other markets, cotton U.S. exports are already the lowest in a decade, the U.S. having lost business to Brazil in recent years. U.S. used to be the world's largest cotton exporter, now Brazil is. We've seen some negotiations concluded or at least progress with some of the major U.S. buyers, Vietnam and Pakistan. China, we're still in talks with them. We've lost a lot of business to China in recent years. There's potential, though, I suppose, out of some results of these negotiations that maybe China taking a possibly more interested look in U.S. cotton. And U.S. sugar imports are already heavily regulated. They have been forever. And so I would not expect the tariffs to have much of an effect there.
And Mark, looking at cotton, what do you expect from this afternoon's crop conditions report?
So this afternoon, the U.S. crop is in good shape. Conditions may show a decline from this week after some dry weather in Texas emerging. Texas did get some decent rains over the weekend, but they may have been too late to make a difference on this week's report, which is as of yesterday. Last week's report showed U.S. crop conditions 55% good to excellent. as of last Sunday. That was down from 57% the previous week, but above a 5-year average of 48%. And Texas was 50% good excellent, down from 52% the previous week. But still, this is better than 41% a year ago on a 5-year average of 33%. So the U.S. crop is very strong. Texas, I would say, exceptionally strong. Like I say, some of the unirrigated regions saw some drying last week, and the area does need some more rain to get what would be called the best dry land production.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.